Most people think they understand Forex. They think it's charts, indicators, and timing entries. They think it's buying one currency and selling another. They think it's about being clever, fast, or right. And that misunderstanding is exactly why most beginners fail, because Forex is not a guessing game. It's not a technical puzzle. And it's definitely not a shortcut to easy money. Forex is a global decision-making system. It's the place where governments, central banks, institutions, corporations, and investors constantly reprice economic reality in real time, and beginners almost always approach it from completely the wrong angle. So if you've ever felt confused, overwhelmed, or quietly frustrated by Forex, let me say this clearly right at the start. You're not stupid, you're not late, you're not missing a secret strategy, you were simply never taught how Forex actually works. And once you see it properly, the market stops feeling chaotic and starts feeling conditional. Forex is not about predicting price, it's about understanding pressure. Currencies move because capital has a reason to move. Money doesn't wake up in the morning, look at a chart pattern, and decide to flow into a currency. Money responds to incentives. Those incentives come from interest rates, inflation, growth, stability, credibility, and risk. Every single Forex trade is a comparison. Whether you realize it or not, you are always answering one question. Which economy offers better conditions right now? That's it. EUR versus US dollar is not a chart. GBP versus Japanese yen is not a signal. Australian dollar versus Swiss franc is not a setup. They are economic relationships. And when you don't understand the relationship, you end up fighting the market instead of reading it. Most beginners are taught to start at the bottom. They start with entries. They start with indicators. They start with strategies. Professionals start at the top. They start with macroeconomic conditions. They start with central bank policy. They start with the broader risk environment. That difference alone explains why outcomes diverge so dramatically. Entries without context are just guesses with better graphics. Forex is the largest financial market in the world. More than $7 trillion changes hands every single day. That volume is not coming from retail traders clicking buy and sell on their phones. It comes from banks hedging exposure, funds reallocating capital, corporations managing currency risk, and central banks influencing monetary conditions. These participants are not trying to win a 5-minute trade. They are responding to economic pressure, and price is simply the visible result of those responses. This is why beginners often feel like the market moves for no reason. They're looking at the surface while the real drivers sit underneath. Let's talk about expectations, because this is where most misunderstandings begin. Markets do not trade facts, they trade expectations. If inflation is high but falling, that's very different from inflation that is low but rising. If growth is weak but improving, that's very different from growth that is strong but deteriorating. Forex traders don't ask, what just happened? They ask, what is likely to happen next? This is why central banks dominate Forex. Central banks don't just set interest rates, they shape expectations. When a central bank signals tighter policy, currencies respond long before rates actually change. When a central bank loses credibility, currencies weaken even if the data still looks fine on the surface. Credibility is currency. Trust matters. This is why the US dollar behaves the way it does. It's not just interest rates, it's liquidity, market depth, institutional trust. This is also why currencies like the Swiss franc and Japanese yen often strengthen during periods of uncertainty. Not because they're exciting, but because they're predictable, and in times of stress, predictability becomes valuable. Now let's talk about interest rates properly, because beginners massively oversimplify them. Higher rates do not automatically mean a stronger currency. Rates must be viewed relative to inflation, growth, and risk. If rates are high because inflation is out of control, that's not bullish. If rates are high because an economy is strong, stable, and credible, that's different. Forex is always relative, always comparative. This is why single indicators are dangerous. No data point matters in isolation. Everything must be viewed in context. This is the foundation of macro-driven Forex trading, and it's why Forex still works in 2026, despite all the noise. The market hasn't become harder, it's just become louder. Now let's talk about risk on and risk off, because this concept alone explains a huge amount of price movement. Risk on environments are periods where investors are comfortable taking risk. They chase growth, they seek returns, they allocate capital into equities and higher yielding assets. Risk off environments are periods of caution. Capital preservation matters more than return. Money flows into perceived safety. Volatility rises. Currencies respond accordingly. Growth-sensitive currencies behave very differently depending on global risk appetite. Safe haven currencies behave differently depending on fear. If you don't know which environment you're in, you are guessing, and guessing with leverage is expensive. This is why professional traders spend far more time analyzing conditions than placing trades. Now let's bring this down to the chart, because eventually you do need to execute. Technical analysis is not useless, it's incomplete on its own. Charts reflect behavior. Support and resistance exist because memory exists. Trends exist because capital takes time to reposition. Consolidation exists because uncertainty exists. Breakouts exist because imbalance exists. Indicators do not lead price, they summarize it. When you understand market structure, you stop hunting for magic indicators and start reading behavior. Is price being accepted or rejected? Is momentum expanding or fading? Is participation increasing or drying up? These questions matter far more than whether an oscillator is overbought. This is why professionals are patient. They wait for alignment. Macro bias, sentiment, structure and execution need to agree. Beginners chase movement. Professionals wait for clarity. Waiting feels boring until you realize boredom protects capital. Now let's talk about time frame, because this is another major beginner trap. Lower time frames feel productive. More trades feels like progress. In reality, lower time frames magnify noise and emotion. Higher time frames provide context. Professionals anchor bias on higher time frames and execute selectively. They don't need constant action. They need consistency. Now let's talk about risk, because this is where most traders don't fail once. They fail repeatedly. Risk is not about being right, it's about staying alive. If you risk too much, you don't need many losses to be finished. If risk is controlled, you can be wrong frequently and still survive. This is why professionals think in probabilities, not outcomes. One trade means nothing. A series of trades defines performance. This mindset shift is critical. Trading is not about winning, it's about operating. Now let's talk about psychology, because this is where accounts quietly die. Trading exposes you to uncertainty again and again. Losses feel personal. Wins feel validating. Without structure, emotion drives behavior. Fear leads to hesitation. Greed leads to overconfidence. Frustration leads to revenge trading. Professionals don't eliminate emotion. They design systems that limit its impact. Rules, processes, journals, not because they're boring, but because they work. Most traders don't need better strategies. They need better decision discipline. This is where structured mentoring accelerates growth, not by giving signals, but by holding you accountable to your own process. Now let's talk about AI, because in 2026, this conversation is unavoidable. AI has transformed how traders access information. It can summarize data instantly, scan headlines in seconds, model scenarios efficiently, but AI does not replace judgment, it amplifies it. If your framework is weak, AI makes you confidently wrong. If your framework is strong, AI becomes powerful. AI is a tool, not a trader. Used correctly, it removes friction and improves consistency. Used incorrectly, it adds noise and false confidence. Now let's talk briefly about gold, because it plays a critical role in macro understanding. Gold responds to real yields, inflation expectations, and risk sentiment. Understanding gold sharpens Forex analysis even if you never trade it. Markets are interconnected. Currencies do not move in isolation. Now let's address expectations honestly. Forex trading is not a shortcut. It is a professional skill. Anyone promising certainty is selling entertainment, not education. There is no perfect strategy. There is no guaranteed system. There is no indicator that removes uncertainty. What works is understanding markets, understanding yourself, understanding risk. This is why structured trading education exists, not to promise outcomes, but to build competence. Whether someone starts with a Forex trading masterclass, a Forex fundamental analysis course, a mini MBA, or commits to a full professional trading program, the goal is the same. To think clearly under uncertainty, to make decisions with context, to operate calmly and professionally. Forex does not reward excitement, it rewards preparation. It does not reward speed, it rewards patience. It does not reward prediction, it rewards adaptation. If you take one thing from this video, let it be this. Stop asking how to trade, start asking why markets move. Because once you understand that, trading stops feeling like chaos and starts feeling like a profession, and that changes everything.